Every time the real estate market slows down, something interesting happens. The headlines become negative. People become cautious. Investors start waiting on the sidelines. And suddenly, everyone begins asking the same question. Is this the beginning of something worse? If you've been in real estate long enough, you start noticing a pattern. The questions change very little. The emotions change very little. And the behavior of people changes very little. What changes are the only reasons. One year it's inflation, another year it's interest rates, another year it's a financial crisis, and another year it's a pandemic. But the emotional reaction is almost always the same. Fear. And that's exactly what I want to talk about today. Not just real estate, not just investing, but human psychology. Because if you truly understand how people think during market cycles, you will understand why opportunities exist in the first place. Let's be honest. If everyone agreed that a certain investment was a great opportunity, it probably wouldn't be an opportunity anymore. Opportunities exist because people disagree. Some people see risks, others see value, some people see uncertainty, and others see potential. And throughout history, the greatest opportunities have often appeared during periods when confidence was at its lowest. Think about any major downturn in history. At the time, it always feels different. People convince themselves that this time the rules have changed, that recovery won't happen, that growth is over, that things will never be the same again. And when you're living through a difficult period, those fears feel very real. The problem is that human beings are naturally programmed for survival, not investing. Our brains are designed to identify threats thousands of years ago that helped us survive. But in modern financial markets, that same instinct can work against us. When we see negative headlines every day, our brains start believing that the future will be an extension of the present. If prices are falling today, we assume they will keep falling tomorrow. If people are pessimistic today, we assume things will get worse. And because everyone around us is thinking the same way, it feels logical. It feels safe, it feels responsible, but history repeatedly shows that the crowd is often most pessimistic near the bottom and most optimistic near the top. Let's think about that for a moment. When do most people feel comfortable investing? Usually after prices have already risen, usually after the market has recovered, usually after the news becomes positive again, and usually after everyone around them is talking about success stories. In other words, after much of the risk has disappeared, but also after much of the opportunity has disappeared. The irony is that the moment people feel safest is often when assets are most expensive, and the moment people feel most afraid is often when opportunities begin to appear. This is not because fear creates value automatically, it's because fear causes people to make emotional decisions. Fear causes people to delay decisions. Fear causes people to focus only on what can go wrong. And when enough people do that at the same time, markets slow down. I've seen this happen many times. When markets are rising rapidly, people become convinced that prices will continue rising forever. You hear statements like, real estate only goes up. If I don't buy now, I'll never be able to buy. This project will double in price. Confidence becomes extreme. People stop asking difficult questions, they stop analyzing risks, and they begin making decisions based on emotion rather than logic. Then eventually reality catches up. The market slows, growth slows, expectations adjust, and suddenly confidence disappears. The same people who couldn't wait to buy become unwilling to buy at all. The same people who were certain become uncertain. The same people who were optimistic become pessimistic. Nothing changed about human nature, only the emotion changed. This is why understanding market cycles is so important. Every cycle follows a similar pattern. First comes optimism, then excitement, then euphoria, then expectations become unrealistic. Then comes disappointment, then fear, then uncertainty, then recovery, and eventually optimism returns once again. The cycle repeats. Different decade, different country, different headlines, same human psychology. One of the most important lessons I've learned in real estate is that markets move much faster than emotions. People are usually reacting to what already happened. By the time confidence returns, smart money has often been positioning itself for months. By the time the public becomes excited again, the recovery may already be well underway. That's why successful investors often appear early, not because they can predict the future perfectly, but because they understand cycles. They understand that uncertainty is normal. They understand that no investment comes with guarantees. And they also understand that waiting for complete certainty is impossible. Let's talk about certainty for a moment. People often say they are waiting until things become clearer. But when exactly does that happen? Was the future clear in 2008? No. Was the future clear during COVID? No. Is the future clear today? Of course not. The future is never completely clear. And yet, economies continue to grow. Cities continue to expand. Businesses continue to operate. People continue to need homes. Families continue to form. Population continues to increase. Life continues moving forward. And the world has experienced wars, recessions, financial crisis, political instability, pandemics, and countless other challenges. Yet despite all of that, human progress has continued. Real estate markets have continued. Development has continued. Growth has continued. Not in a straight line, not without setbacks, but the long-term direction has continued. This doesn't mean every investment succeeds. It doesn't mean every project performs well. It doesn't mean every market behaves the same way. What it means is that fear should not replace analysis, emotion should not replace strategy, and temporary uncertainty should not automatically destroy long-term conviction. As someone working in real estate, I speak with investors every day. Some are extremely optimistic, some are extremely pessimistic, some believe prices will rise dramatically, others believe prices will fall dramatically, and the truth is that nobody exactly knows what the next 6 months will look like. Nobody. Not analysts, not brokers, not economists, not investors. The future is uncertain for everyone. The difference is how people respond to that uncertainty. Some people become paralyzed, others become strategic. Some people focus only on risk, others focus on both risk and opportunity. Some people allow emotions to drive decisions, others rely on preparation, research, and discipline. And over the long term, that difference matters enormously. You know why? Because investing is not simply a financial activity. It is a psychological activity. The biggest battle is often not against the market. It is against your own emotions, against fear, against greed, against impatience, against the desire to follow the crowd. History teaches us many things, but perhaps the most important lesson is this. Every generation believes its challenges are unique. Every generation believes its fears are justified. And every generation believes that this time is different. And yet, time after time, markets adapt. People adapt, businesses adapt, cities adapt, and recovery eventually follows. Not because recovery is guaranteed, but because adaptation is one of the strongest forces in human history. So when you look at today's market, don't just ask yourself what is happening. Ask yourself how people are thinking. Ask yourself what emotions are driving decisions. And ask yourself whether fear is influencing your perspective. And most importantly, ask yourself whether you are reacting to the market or understanding it. Because the people who achieve the greatest long-term success are not necessarily the ones with the highest IQ. They are often the people who remain calm when others panic. The people who stay patient when others become emotional, the people who think long term when everyone else is focused on today's headlines. In the end, real estate is not just about buildings. It's not just about prices. It's not just about investments. It is a reflection of human behavior. And human behavior has remained remarkably consistent throughout history. Yes, the headlines change, the circumstances change, the technology changes, but fear and greed remain the same. And if you can learn to understand those emotions instead of being controlled by them, you will already have an advantage that many investors never develop. Thank you for watching. If you enjoyed this video and would like more content about real estate, investing, psychology, and market cycles, subscribe to the channel. And remember, the crowd feels smartest at the top and most fearful at the bottom. Your job is not to follow the crowd. Your job is to think for yourself.